Welcome to Inside Economics. I'm Mark Zandi, the Chief Economist of Moody's Analytics, and I'm joined by only one of my co-hosts, Cris the Deputy Chief Economist. Hey, Cris,
Hey,
what's
Mark.
going on? We lost Ryan. I thought he said
I
he was,
know.
a lifer for this podcast, but he bailed on us.
I know. I don't know what's happening.
Family
Hopefully
comes
temporary.
first, I think. He told, I
That's
think,
true.
is he at Hershey Park? Is that what he said? He's at Hershey Park?
Yeah, that's right.
Oh,
That's right.
okay.
Took the family there.
Have you
Loading up
ever
on
been to Hershey
chocolate.
Park?
I have not been to Hershey Park.
Oh, you got to go to Hershey Park. I mean, I can't believe that. Well, you're kind of shishi. You're shishi. You only go to Disney World or something with your kids. When I
Haven't been
was,
there either with my kids. So,
oh,
I got
the heck? You've not been to Disney World?
Nope, nope.
Oh, well, I
Holding
I
off.
highly
Holding
recommend
off.
Hershey Park. I mean, I have this I had three kids, and we all went to Hershey Park back in the day when I was your age, and I have this iconic photograph of my middle daughter, Anna, holding up a Hershey bar. And she was so happy to have that Hershey bar. I'm telling you, it was like the best thing in the world. Actually, if I could find that, I'm going to put that up with the podcast. So it's like one of my favorite pictures of all time. The three kids, my wife and me, and my daughter holding up the Hershey bar with great excitement. Yeah,
Pure
so
joy. Pure joy, I
pure. It
guess.
was pure. It was pure joy. It was pure
Yeah.
joy. But yeah, well, we'll miss Ryan. Um, actually, this gives me a more of a chance to win the statistics game. Although I was beating him pretty easily, I would say, right, Cris? Haven't I been beating him pretty regularly?
You've been on a hot streak.
I've been on a hot streak.
Yeah. And
So much
last
so
week
that last week
yeah,
everyone thought it was a plant. Yeah,
that was amazing. So
amazing.
a fair warning, I upped my statistics game this week. So,
Uh-oh.
in light
All
of that,
right.
so just keep that in mind.
And we have two guests. One, our favorite colleague, Mike Brisson. Hey, Mike, how are you?
Hey Mark, how's it going?
Good. Mike's all things vehicles for us, and good to have you on board because this is the topic of the podcast, the vehicle industry. And we've got Jonathon Smoke from Cox Automotive. Thank you for joining us, Jonathon.
Oh, it's great to be with you guys.
Yeah, and Jonathon, before we dive in, maybe you can give us a quick sense of Cox Automotive, just to give the listener, because you guys are doing lots of different things. It'd be good for the listener to
Yeah,
hear
we are,
about.
and we're a privately held company, so the name
Oh,
Cox doesn't necessarily register with a lot of folks. But we are the largest auto services company in the world. You mainly know us from the brands that are more well known. We own Mannheim Auto Auctions, which
mm,
is the largest commercial auction house in the U.S. and in several other countries as well. We also own the consumer-facing websites Kelley Blue Book, which has, I think, about 100 years of helping dealers and consumers understand vehicle values. And Auto Trader is the #1 destination for shopping for new and used vehicles in the U.S. So we've got quite a bit of understanding of the consumer and dealer side of things, but we also own various software products that are basically the underpinnings of how dealers run their businesses. So
oh,
it was very attractive when they were looking for a chief economist for me to think about the treasure trove of data, because for those of us that have applied our profession at being a business economist, we know that having data is sort of key to really having good insights. And
absolutely.
Yeah.
so that's what got me to do this.
Cool. And interestingly enough, you were what I would call a houser before you became a vehicle maven, right? You were in the housing industry. You were at Realtor.com. You were at Hanley
Yes.
Wood. Yeah.
Yes, and as a result, I've been a close client of Moody's Analytics and back to the old days of Economy.com.
Oh, I didn't know that.
Yes,
All the way back to economy.com.
that's right.
You look too young for that. I don't know how. Yeah.
Yes, I am. I look a lot younger than I really am. It's had its disadvantages at times, but now I'm of an age that I enjoy it. But yeah, I started off in home building and actually ended up being responsible for strategy for national public home builder. And as a result, really sort of tapped into my economic roots to really build models and help understand that. And that's really, I think at one point, your team used to tell me that I was the single biggest user of Data Buffet when it
No
was
way.
issued,
No way.
because
Oh,
we were
that is,
building models and downloading
yeah.
data at a local level, trying to connect the dots with what was happening in housing.
So
I
you know
ended
my
up,
brother. You know my brother Karl well then.
oh yes, yes, we actually have a joint project that Mike and I have been doing for probably a year and a half, maybe 2 years on vehicle affordability. So yeah, the roots go back a long way, but started in housing. So I did home building. I then created my own data company for a while called housingintelligence.com.
Mm.
And
Oh, wow.
I had the best of all timing. I started that in the fall of 2006 and was doing extremely well until
For
until
about
2008.
yeah.
Things got a little bumpy. I
Yeah.
did predict that we would have a decline, but no one predicted quite the decline that we had. I ended up selling that business to Hanley Wood, which is a media and data business for new construction. And that's actually where I first started getting the title of chief economist.
Mm.
And so really focused on home building and home improvement and building product type of industries. And then I was recruited by Realtor.com to become their first chief economist. So I got to live in that elite world of the competitive economists that have been in that space across Zillow, Redfin, Realtor.com, super exciting. And then the opportunity at Cox came up, and I had originally been from Atlanta. Cox is based in Atlanta, fantastic kind of family run business, and the opportunity to learn a new industry was entertaining and to me in a way to kind of keep the juices flowing. Plus, as I shared with you, the treasure trove of potential data was the real kicker. And I've been here 5 years now, so
Fantastic.
time flies.
Thank you for joining us. It's a real pleasure and honor to have you. And we play this statistics game, and I'm hopeful you'll be able to play and willing to play. But I'm afraid to say with Ryan kind of AWOL, we don't have the cowbell. We ring this cowbell if you get the answer right, and that certainly shows a flaw in our planning here. But my
Supply
problem
chain.
is supply chain problem. Yeah, actually, it's a brother problem. My brother Karl. I've been after what I want to do is I want to give guests like you a cowbell. I give we give a guest a bottle of wine, but I want to give a cowbell. But he won't give me budget for it. I don't know what the hell. I got Karl, come on, give me some budget for the cowbells. And he goes, no, budgets are tight. Is what he tells me. My own brother. No
He runs a lean
cowbell.
ship,
Yeah. What's that? Lean? He does, doesn't he? He runs a lean chip.
Well, global supply chain problems, it's tough to get those cowbells. So
It's tough to get those cowbells. But anyway, all right. But back to business. Why don't we start with there's been a couple of major economic releases this past week. The first was the Consumer Price Index, CPI Inflation. Cris, you want to give us a rundown on what was in the CPI report?
Sure. I'll give you a high level because I don't want to take anyone's numbers away. So CPI inflation for March was reported on Wednesday. It was in line with, I would say broadly in line with consensus. Consensus was for inflation to be high, and the BLS did not fail to deliver. Headline inflation was 1.2% month over month, so from March to February. So that is high. It had been 0.8% the month before, so some acceleration. And then on a year-over-year basis, the number everyone's quoting is 8.5% year-over-year. So that is the highest since December of 1981. I don't know what you were doing back then, Mark, but there's a lot going on. A lot going on back then.
I was just about ready to ask my wife out for a first date, I think, in 1981, believe it or not. Yeah.
You had to go. You had to be quick because the prices were going up, right?
That's right. That's right. That's absolutely right. I remember those days pretty well, 1981. I probably could tell you
Yeah.
the unemployment rate. Let's see, June of 1981. Uh, that was kind of in between recessions. I'd say the unemployment rate was about 7.3. Someone should go see June of 81. No, 7.3. Yeah, Mike's looking.
Mike's looking. All right.
Yeah, Mike's looking. Anyway, what was I
Anyway,
going to say?
so
How much of this pickup of inflation would you ascribe to Russia's invasion of Ukraine and the resulting surge in oil and other commodity prices? How big a deal was that?
yeah, so definitely, gas prices were up 18% alone, right? And BLS subscribes 50% of the increase to gas, right? Energy prices more broadly were up 11% in March, 3.5% up in February. So it, just compounding the impact there. If you want a little bit of, well, let's everything's relative. A bit of good
Yeah.
news is the core inflation. So
Yeah,
inflation less
but
food
before
and
you go
energy.
there,
Oh,
I guess I would
yeah,
say the obvious the connect the dots Russian invasion to CPI was gasoline prices, but
right.
obviously that affects lots of other stuff in the CPI, like food
Food
prices,
food
right?
prices were up 1% as well, right?
Yeah,
So
because
uh,
diesel prices, you got to ship the stuff from the farm to the store shelf, and diesel prices are at record highs because of Russia invading Ukraine.
absolutely.
I saw airline
Fertilizer. Yeah.
fares, right? I mean, they were up,
Hmm.
I think, a lot. I think
Yeah,
a lot going on there related to higher jet fuel costs, that kind of thing. So felt
that's
like to
right.
me, correct me if I'm wrong, but I felt like, or if you have a different view, that a big chunk of what was going on here was Russia's invasion of Ukraine. Kind of really,
That definitely was the
yeah,
accelerant here. I will say owner's equivalent rent, we've talked about this before. So the housing portion of this was, it increased 0.4% as well. It's the same as the previous month, but that's still kind of this underlying slow moving factor that is going to continue to prop up inflation for a while. The price gains that we've had over the last couple of years still have to make their way through the um, the CPI inflation.
yeah. Okay, so the good news. What's the good news?
Good news,
I
I
think
would
you
say,
said good news. Yeah,
like a bit
relative.
relative,
Yeah.
the core inflation. So inflation less food and energy, that grew at a 0.3% month over month rate, which was actually down from February, which was growing at 0.5%. So a little bit of deceleration, hopefully, going on in the core. So but it's still 6.5% above last year's level. So the um, the light is still green for the Fed to move here, right? Clearly, 6.5% on the core is way too high. So there's little doubt, and there's actually no doubt that they're going to be very aggressive in May with rate hikes and quantitative tightening.
I think one of the key aspects of the moderation in core inflation, ex food and energy, was a decline in used vehicle prices, I believe. I think new
Yes.
kind of was flattish, but used was down. So I'd love to bring the auto mavens into the conversation here. Jonathan, what's going on with vehicle prices? I mean, obviously they went stratospheric, back beginning about a year ago, I think, and are they now coming back down to earth? So what's the dynamics here with regard to using? Because and also, correct me if I'm wrong, but I think the movements in vehicle prices have had a very significant impact on overall inflation, if I'm not
They
mistaken.
have. Goods inflation has been the story up until now, really. And
Mhm.
last year, ground zero was the auto market, and the used market, which because of the Manheim index that we put out, was the poster child for how extreme the inflation was, how quick we were seeing those prices move up. And it was all tied to the chip shortages, semiconductor shortages, and a lot of the supply chain problems that were very acute, but also clearly related to the environment and the amount of stimulus and the real frenzied spending that especially we had a year ago. So, jump forward to now, and what we've been seeing this year has been a moderation in pricing. We've seen used vehicle prices, both wholesale and retail, come down in the first 3 months of this year. The CPI is tracking retail used prices, but there historically has been a pretty tight correlation over time with what the Manheim Index sees. By the way, I'll put a plug, especially because of it's in your neighborhood. If you've never been to an auto auction before, sometime you've got to go see Manheim in Manheim, Pennsylvania, the largest
in
auto
Pennsylvania?
auction.
I didn't know that.
It is.
Oh,
That's
okay.
namesake is the town, and it is a thing to behold, because I would argue outside of the stock market, it is probably the best example of an efficient and live market that you're ever going to see in your life. Plus, it's pretty cool to see all the vehicles.
Yeah, where's Manheim, PA? Where is that relative to Philly, where we live? Do you know?
It's north of you, closer. I've
Scranton,
driven
Wilkes-Barre?
and I've flown, but
Yeah.
asking the wrong guy for that.
Well, that sounds like a day trip. Maybe we'll take a Moody's Analytics excursion up to Manheim, PA.
Do the podcast up there. Yeah.
Oh, we
So
could do
the reason why I
podcast.
bring it up, the wholesale market is a very dynamic market. Historically, it has more price movement in it because effectively every day the market is attempting to clear based on supply that's feeding the market and what the available demand is. And I will describe what we've gone through in the pandemic is the most extreme demand versus supply gap that we've ever seen historically, because we literally had an absolute limited supply situation because of new vehicle production stopping worldwide. There had been no scenario, perhaps, you can say World War II was this way, but in the modern era, there had never been a time that all the factories in the world were shut down and all of the supply chains were shut down. Then you had the mistakes that the manufacturers made of actually canceling orders of goods, and semiconductors was where there was a real problem with that. So it wasn't just about getting the factories back up and running, it was actually getting the supply chains running that feed that. And because of decades of globalization, generally speaking, there wasn't a lot of resiliency in the global automotive production landscape. And so we never got back to 100% capacity. We were getting close in the fall of last year when then the Omicron wave of COVID struck.
Yeah.
And then we've entered into another series of unfortunate events. We've been dealing with things like earthquakes in Japan, Canadian trucker strike, the Felicity Ace, the cargo ship that caught on fire and sank, taking down 4,000 European luxury cars with it. Really? So all kinds of random things have also contributed to this. So you've got acute supply challenge, boosted demand, because not only did we have stimulus and record low.
Although, can I interject there quickly, Jonathan, vehicles, vehicle sales never really got very high, right? I mean, we were getting 17 million units per annum sales, rock solid before the pandemic. And was there ever a month we got above that since pandemic hit? I don't think so.
No, we had a few strong months at the very beginning when we reopened the economy and we had more supply, and the very beginning of last year. Have to check what the BEA numbers
I don't
were.
think we ever got much above.
March and April of 2021, we got 18.
Oh, we had
those
a month
2 months.
Or two.
Yep.
Yeah. But
records.
It feels like to me in this debate about demand, whether the high inflation is related to demand or supply, in the vehicle market, it's got to be mostly supply, right? Yeah.
I would say it was both. I think
Really?
it has been more of a supply problem, and it's all theory, but I would say we probably would have sold more than 18 million vehicles last year had we had
supply,
normal level of supply.
Yeah. I mean, here's a statistic. Because I calculated this for this conversation. If I look at the 5 years prior to the pandemic, the average annual sales rate was 17.25 million. Since the pandemic, it's been 14.65 million. So, that's not demand, that's supply, right? I mean, you just can't produce enough.
Yes.
Yeah.
You can also, another aspect is describing what is the fundamental demand, what's the natural demand for vehicles. And we've actually seen an increase in the scrappage rate, so the number of vehicles that are lost and have to be replaced. And that typically contributes to a higher level of fundamental demand. But I would argue, one, during the pandemic, you also had people's preference moving away from shared and public transportation. And so there was a period of time that people who had no vehicles were looking for vehicles. But then what we started to observe with mobility and people's movements to different places for housing, whether it was buying housing or renting housing, but the movement away from dense urban centers to places that are more vehicle dependent, created also a trend that we were essentially following what was happening in the housing market. And historically, vehicle demand is correlated with the housing market. The more home sales you have, the more vehicle sales you have. And the more homes are being built, the more pickup trucks are in demand all throughout the country. So that too has contributed to a higher level of demand than what we had before.
I want to come back to sales, but before I do that, I want to come back to price, because I want to try and understand where prices are headed. So my simple way of thinking about this is that, okay, pandemic hits, factories shut down, severe shortages, prices for new cars go skyward because they're so expensive, and because of the pandemic, demand for used vehicles goes skyward. So prices are just jumping everywhere. Okay, here we are today. We're still not producing. The worst of the supply chain problems seem to be past us, but there's still issues, and production hasn't quite gotten back to where it needs to be. Yet, used vehicle prices seem to be. New vehicle prices haven't rolled over yet. They've stopped rising, it looks like. But used vehicle prices look like they've rolled over. Okay, so what's going on? Why? And where are we headed? I mean, where are prices headed here now going forward?
Well, as I was mentioning, wholesale prices, I believe, are the most dynamic and will truly reflect the market conditions at any given time, more so than any version of retail prices, and especially new retail, which has this, process of a manufacturer establishing what the suggested retail price is, and then seeing actually with the marketplace. And that's a place we ought to go actually in the data, because there's some extraordinary trends with people paying well above the MSRP, which was an unheard of concept prior to this current situation. But it takes an extraordinary imbalance of demand versus supply to take an asset that fundamentally is a depreciating asset and turn it into an appreciating asset. And yes, we had that scenario in 2021 where in most weeks, the prices at Manheim were higher each week than they were the prior week. But that is not the case now. Well, actually, technically, it is the case again in April, because we're in the heart of tax refund season. And a little unknown fact to the broader world is that every single year, and we've got data back to 1995, every single year, prices have gone up in tax refund season in the wholesale market, because there is always a temporary surge in demand and a limited amount of supply that moves into the market at that time of the year. But outside of that effect, I believe we're fully back to vehicles being depreciating assets again. That doesn't mean that we're going to see a price correction, a return to where values were previously. It just means that prices are performing on a go-forward basis in a much more normal way, meaning your vehicle is likely to be worth 10% less a year from now than it is today.
So economic gravity's taking hold again. It was suspended for a while, but now
That's right.
it's taken hold again. Prices are coming in. So do you expect used vehicle prices to continue to decline here going forward, at least for the foreseeable future, next 6-12 months? And what about new?
We do on the used side expect to see fairly normal depreciation, which should mean vehicle prices go down. Now, depending on how you measure that, though, things like the CPI, things like the Manheim Index itself naturally has price increases over time because vehicles constantly have new technology, new capabilities that essentially have an inherent inflation bias kind of built into it. So historically, wholesale prices have gained about 2% a year. If you adjust for inflation, that really typically gives you what the view is. And interestingly, with very high inflation now, and we think we're going to see a 3% decline this calendar year in the Manheim Index, that really means a much bigger decline than normal in the calendar year for wholesale prices.
Good. And new, I guess that depends more on supply chain issues and if production picks up and so forth and so on.
New is one where I would continue to expect above average increases in prices. There is some seasonality to how new prices come out. Typically, the highest prices are when new models are being introduced. So it's the end of the year. And we're in the time of the year where prices are tending to come down slightly. So indeed, December was the most recent peak we had in new vehicle prices, and they've come down the last couple of months. But we're in an environment where supply is right around 1 million units, 1.1 million units at the end of March, when typically we have 4 million units. We were just shy of 4 million units in the same time frame.
I'm sorry, what's that number? 1.1 million? What is that?
That's the number of new vehicles sitting on dealer lots.
Oh, dealer lots. Okay.
The inventory. Yeah.
The inventory. Okay. Yeah. So inventories are still, we haven't been able to get production up. Vehicle producers haven't gotten the production up yet to start rebuilding inventory.
No, and because inventory's been decimated, it basically means we will sell only what gets produced and delivered to the U.S.
Okay, so you're saying, okay, used, that's coming in, economic gravity is taking hold again. New, that's going to take a while before that really starts to come in to any meaningful degree. Hey, Mike, do you agree with that? Do you have any different perspectives on that, or is that roughly with what you're thinking in terms of new and used vehicle prices?
I'm expecting the used vehicle prices to be pretty flat throughout this year, not have that much of a come down. That would make sense with what Jonathon said, because they already saw a 3% decrease in this first quarter. So they're probably expecting it to be flat the rest of the year if you're expecting a 3% decrease for 2022. So we're thinking that it stays flat through 2022 and starts to come down in 2023. And that's a supply and demand story. So you have vehicle production starts to normalize in 2023. You also have the Fed putting the brakes on. So the demand side is something we should forget about here. There's going to be some loss of demand over the end of 2022 into 2023 as interest rates rise. And that's going to be part of the story as vehicle prices come down.
And new? What about new?
New, I think the manufacturers are playing catch up with the market. So we're going to see prices come up. So all those people that are paying above MSRP, the OEMs aren't going to leave that cash on the table. They'll start raising MSRPs so the dealers can charge it and not feel so bad about it. Like they're doing something wrong.
And there is one wild card that's interesting to talk about because it relates to the CPI numbers as well. Because one of the biggest gains for the month in March and in the year-over-year category is car and truck rental. And the rental car companies traditionally get all of their fleet from new vehicle manufacturers. They're new vehicles that get put into the rental fleet. But with the supply problems last year, rental car companies became net buyers of used vehicles instead of traditionally feeding the used car market. And that is continuing this year. And if that behavior continues into the fall, we could see there's upside to the used prices, and it's principally driven by those rental car companies. whose economics are extremely positive because of the scarcity of vehicles and the resurgence in travel that's happening. All those people going to Hershey Park and the like.
So just bringing this back full circle to what it means for overall inflation, I think what my conclusion is from the conversation is that vehicle prices really, which added significantly to inflationary pressures over the past year, that's not going to be the case in the coming year, but it's not going to be a big drag on inflation until we get into 2023. That's what it sounds like you're saying. Both of you are saying, roughly speaking.
Yeah, I think there could be times, especially in the seasonally adjusted series, that it could be somewhat of a drag in certain months,
somewhat of a drag,
especially as demand starts to soften and indeed the production starts to improve. As Mike.
All right, I'll take it. We need it. Yep. Okay.
And to that point, the seasonally adjusted numbers went down for the Moody's Analytics price index, and they went up for the unseasonally adjusted in March because there is this big seasonal factor in March and April that Jonathon was talking about as dealers start to build up inventory. So the seasonally adjusted and non-seasonally adjusted went in different directions in our index. So it is a big seasonal factor here too.
Yeah. Hey, Cris, given all of this and everything else that you throw into the pot, would you say that inflation, overall inflation, has peaked in the U.S.? 8.5% year over year CPI through March, highest it's been since 1981. Is that the peak, or are we close to the peak? What do you say?
I think we're close.
Close.
If not already there. Really, because so much of this is driven by energy and gas prices. If you do believe that there are no more sanctions coming to restrict some of the supply, and we will get some additional supply coming from other countries in short order, that should help to bring those gas prices down, maybe gradually, but at least they shouldn't accelerate much more from here. And if the Fed is stepping on the brakes here, that also is going to reduce some of the demand out there. So,
okay, all right. Hey, maybe we'll play part of the game now, or I'm not sure we're going to play all of the game, but I got a really good question that's apropos to the conversation up to this point in time. So would you mind if I
fire away
that forward? Just to mix things up a little bit. Is that okay? All right, because it's a little bit different. So just to remind everybody, the game, the statistics game, we each put forward a statistic. The rest of the group tries to figure that out through questioning, clues, deductive reasoning. The best question is one that's not too easy, that everyone gets it right away, not too hard that no one will ever get it, and a bonus if you can make it apropos to the conversation and to recent statistics. Okay, so this is a little different. This is instead of me giving you a statistic, I'm going to pose a question to you, and everyone has to look up. You can't look at your screens. I don't want anybody looking, at the BLS CPI report. But if you go into Table 2 of the Consumer Price Index report from the Bureau of Labor Statistics, that's the detailed accounting of all these prices for all these goods and services. So I don't know how many there are, but there's got to be a couple, 300 of them. Whoever gets, and you can do this as a group, if you can get 3 items for which the year-over-year price actually declined, you win. Okay, you're a winner. So of all the goods and services in Table 2, hundreds of services, which items, goods or services, actually fell year over year in the month of March of 22? And there aren't many. Obviously, there aren't many.
Used vehicles. Okay. We just said it.
Okay.
That's one.
And that's easy. Used vehicles. Oh, wait. Hold it. No. That's not down year over year. That's down month to month.
Month over month. Okay.
Yeah. No. So forget about that. I was wrong. That's not one of them. Okay. Let's see how good you guys really are.
Smartphones.
Smartphones. Yeah. Ding, 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 ding. Very good. That's a good one. Why? Because that's more the quality adjustments, I think.
Right.
So the CPI tries to account for the quality of whatever it is you're buying. Like vehicles, they do the same thing. And, even if the price, the actual price is rising, the measured price in the consumer price index could fall because the quality of the product is improving, like a smartphone. Jonathon, you were going to say something?
I was going to guess something related to sporting goods. Pelotons are top of mind to me as suddenly no longer being the focus.
I think Peloton's a little too narrow of a
It's,
good. That may actually, I did read that. I think they are cutting their price, although they're going to raise their subscription fee. And the only reason I know this is because I'm a avid Peloton user. So, but no, that isn't in. I think that's too narrow an area. But no, not sporting goods. I didn't notice that.
There has to be some sort of commodity that was really high in the beginning of the year. So lumber, I know that skyrocketed in late 2020, early 2021. Has it come down at all, or?
No, that's not it. Yeah. All
How
right.
about
Go
how
ahead.
about some type of personal goods that we were
Okay.
buying last year? I'm thinking, something related to kind of healthcare. Probably could be down on a year-over-year basis. Just
And-
because
And sanitizer.
Well, another kind of straightforward. No, no, not really. But go back to Chris's smartphone. What else goes along with a smartphone? What else are you buying? The smartphone is the phone itself.
Yeah, the service, the cellular.
The wireless service, that's
yeah.
declining in price. Wireless service prices was declining in price.
Is that your Mint Mobile coming online, and
What's
Straight
that?
Talk Wireless and Mint Mobile?
Yeah, I don't know exactly what's the
discount
dynamics
carriers.
there. Yeah, but the measured price is down in the CPI year over year. Technology. What other technology?
PC.
PCs. They're down. Yeah. How about consumer technology, like TVs? Yeah. Audio equipment. Okay, here's one that'll blow your mind.
Oh, film and photographic, right? That's
Yeah,
always down.
exactly.
VCRs.
Yeah. Actually, that is one. Yeah, the VCRs, they're falling in price. Yeah. Here's one that's really interesting. Checking and other bank services. Checking account and other banks, which makes sense, right? Because obviously a lot of online competition for financial services. But one others, and I don't know what's going on here. It might be just a technical artifact. Food at elementary schools, maybe because schools are closed.
Yeah.
Maybe they aren't opening. I'm not sure what that's all about. But that's it. That gives you a sense of what's going on. Usually there's a lot of things that have prices are falling. Certainly as measured in the consumer price index, but not here. So I thought that was pretty illustrative. No cowbells, I'm afraid, but not bad, not bad. Does anyone else want to do? Does anyone else have a statistic that's apropos to the discussion so far?
I've got one for you.
Okay, fire away, Jonathan.
And this is really going to put Mark to the test.
Uh-oh, geez.
It's $204 billion.
204 billion. Is it something related to consumer purchases, consumer spending?
I would say it's directly related to buying power.
Oh, buying power.
Import, export. Difference that came out this week.
4 billion. Is it like I'm going to make this up just to throw it into the mix and maybe we get some clues. Is that the amount that people have to spend on interest on their auto loans?
That's a good guess.
Huh?
Yes, and I sort of teased the concept earlier when I mentioned something that was impacting the seasonality.
Oh my goodness, this is really tough.
Oh, refunds? I'm sorry.
Oh, tax refunds.
Yes, 204.4 billion is the amount of refunds issued by the IRS as of April 1st this year. So the latest numbers.
Is that up or down?
Or is that on track? Yeah.
Down 4% against 2019, which was our last sort of normal cadence, despite the average refund being up 14%. So basically what has happened is tax refund season is about 4 weeks behind normal. And as a result, in the used car market, we typically see a surge in sales in March, and it didn't happen in March. It's happening now in April. And that's why we're seeing a lot of the seasonal adjustments really cause strange movements, and non-seasonal moving one way and seasonal moving the other way.
That's interesting.
And it impacts credit too, because delinquencies have an extreme seasonal pattern to them. And it's based on the receipt of funds that is pretty sizable, because tax refunds will probably be about 400 billion this year.
So why are they delayed 4 weeks compared to like
Backlog.
pre-pandemic?
The IRS is just so far behind.
So far behind. Oh, interesting. Okay. So that has depressed, I mean, the conclusion is that it may be depressing like retail sales for March were soft, and we'll come back to that in a second. That could be because refunds were shy of where they're typically by the month of March.
By my calculation, I make a projection of how many people will receive a refund. And based on that estimate, I estimated using that number that less than half of folks who will get a refund had received one by then, when at the same point in 2019, 77% had received their refunds by that point.
Interesting. Okay, good. Oh, that's a great one. Should we move on? Oh, Mike, you got one? Okay. Fire away.
I got two numbers. Positive 7.6%, negative 1.3%. A couple of hints. This is a release we used to cover on Economic View. We don't have it on there anymore, and I used to write it. And the other one is this is the highest. The 7.6% is the highest growth rate since 2017.
Oh, wow. Okay, so two statistics: up 7.6, down, what'd you say, 1.3?
1.3, and they're both year over year.
And this is a release.
Auto related.
Auto related. Is it auto finance related?
Yep.
Is it
the affordability?
Loans are up 7.6 and leases are down 1.3?
Nope.
Nope.
Close. We're getting so it's balances are up 7.6%, but accounts are down 1.3%.
Okay, well, I got to get some credit for that. Close, but you're right. That's a good one. So you're saying auto loans and leases, outstanding, are up 7.6% year over year through, I guess, March.
Yes.
That's based on credit file data we get from
This is the credit forecast release we used to do.
Equifax data, the credit file data. And you're saying that the number, so the number of people with vehicle loans is down 1.3.
Yes, and that's the largest contraction since 2011.
2011.
So the average
recession.
is
up. Oh.
Yeah,
so that goes to the higher prices, I guess.
Higher prices, but it's also the first sign of depressed demand that we're seeing. That maybe some affordability issues. I mean, our affordability index that Cox and Moody's does together is at the highest level or near the highest level. It takes almost 43 weeks of income to purchase a median family income to purchase a new vehicle. We have that index going back to 2012. And this is at the same time we had the loan officer survey where they're saying they're loosening lending standards. So they have the diffusion index on the lending standards from the loan officer survey from the Fed. And that's the spigots are open. All different credit scores are increasing in balances. So they're not constricting, thinking that there's a risk out there. I think it's more on the consumer side saying that they're not going in and we don't really want to take out a loan for this vehicle if we think the prices are going to come down in the near future. So I think it's the first sign of demand starting to get hit.
Can it be demand destruction? The prices, I guess that's what you're saying. The prices are so high, I can't afford this, so I can't buy. Or they can't. Isn't it there's no inventory too? They can't buy because there's just no inventory?
Yeah, supply is definitely a part of it too.
Yep.
Because a big chunk of that total account decline year over year is in leases. Leases are down 11% in my read of the Equifax data year over year as of March. And the lease story is a supply, it is fundamentally a supply story because traditionally manufacturers subvene and make those lease payments pretty more attractive than financing. and they are simply not attractive at all. So lease penetration is at the lowest level in more than a decade as a result.
Interesting. Okay,
When
that's a
prices
good
this
one.
high, risks are really high for just these loans going underwater. And so even the lease side, does the lender want to give a lease out if they think prices are going to come down so quickly that they'll end up losing a lot of that? They take on a lot of that residual risk when they start making assigning payments for those leases.
Yeah, for sure. Yeah. I mean, yeah, things are so topsy-turvy that they just don't know what to make of it, right? So the natural instinct is turn cautious.
Yep.
Not do them. Yeah. Okay, that was a good
Yeah.
one. And in terms of credit quality, in terms of delinquencies and repossession rates on vehicles, that's still pretty good, right? Or
Yeah,
very good.
it's 2.5%, I think, is the total auto delinquency rate, and that's would be prior to the recession, that'd be the lowest of all time. So it's come up
Okay.
from the bottom, which was close to 1.5%, but it's up to 2.5%, and that still would have been an all-time low prior to the pandemic.
I guess, when you think about it, why would, I mean, you got low unemployment, you got lots of jobs, you got,
Student loans deferred.
student loans deferred, you got vehicle prices that are up. So, you got
Big
equity,
options.
in the
Yep.
car,
You might have locked in a low rate, right? So,
locked in a low rate.
yeah,
Yeah.
so
So it all feels pretty good. And underwriting has been pretty good or okay. Not, it's okay, I guess, is the way you would characterize it. I would characterize it. Would you agree?
It's the early on, right after the pandemic, it was only high risk scores that were getting loans. They've gone down into the low prime, subprime, much more than they were right after the pandemic. So banks and finance companies are getting a little risky. Banks more than finance
Okay.
companies, so which is
Now
surprising.
they are, but what
Yes,
the
but
with the
prior to that, it was all
yeah,
very high
okay.
credit scores. Yep.
Got it.
how about the loan term? Are there still a lot of 7-year and 10-year auto loans?
Loan terms are growing. That's part of the loan access that's expanding. The average is right at 70 months right now.
Okay.
And you are seeing an uptick as prices and interest rates are going up now. You are starting to see that move higher again. But it's still a very low percentage that are more than 7 years.
Yep. And good news on that for data nerds. The Federal Reserve, they usually only release the 60-month interest rate and the 48-month interest rate, which is laughable since no one gets a 48-month loan anymore.
Yeah.
But they're going to start releasing the 72-month interest rate sometime this year. So it's good news for all of us.
Yeah.
Yep.
Well,
Yeah.
and also since we were talking about CPI, for data nerds in the auto business, get ready for a major change in the new vehicle component of the CPI.
You
Because
guys
it's
are really, really, you're almost too nerdy for my taste, Chris. Huh?
But that was
Now we're gonna get a lecture on the change in the vehicle price in CPI index. Go ahead, Jonathan. Feel free. Go ahead.
Well, we did housing not too long ago, right? We went deep
I
into
predict
the.
headlines next month about new vehicle prices, substantially revised higher.
Oh,
They
really?
basically have been testing a new methodology that I believe is way closer to reading what is happening in the marketplace. And the last comparison I did would suggest that new vehicle prices are up more in the range of 19% year over year, rather than, I think the latest one was closer to 12%.
Oh, goodness.
Wow.
Oh, goodness. So we are going to see, this is next month, you said, for the month of April?
I believe for the month of April, in the numbers that get released in May, will include the shift to the new methodology.
And it's not a level shift in price. It's going to actually affect the growth rate over the past year?
Well, yeah, they're restating the historical series by shifting this methodology. Yeah.
But you think it's going to show an even greater acceleration in new vehicle prices?
That's right.
So
Which
inflation, we may not have peaked on inflation then, if that's the case.
Yeah, I might need to change my tune here. So.
But it's important for this intellectual exercise of where used vehicle prices need to go, because the absolute relationship that governs where used vehicle prices has to be what new vehicle prices are, because they are the tether or the anchor to which the used vehicle prices can't get too far away from. And we think that new has not been measured accurately historically, and this will be a big move in the right direction.
Okay, well, let's keep our eyes on that one. That's interesting. Hey, Cris, is your statistic relevant to prices, or should we move on and come back, or what do you want to
It
do?
is relevant, so let's get it out of the way.
Okay, then fire away.
It's a twofer, 4.7% and 20%.
4.7 and
20.
20. Is this in the CPI report?
It's derived from the CPI.
Oh, this is your own concoction coming
No,
out of
it's
the
not my
CPI?
own concoction. It is released, officially released at the same time.
But it's not a
as
part of the Consumer Price Index report.
It is not. It is not released by the BLS.
Oh. Is one month to month, the other year over year?
They are both year over year.
They're both year over year. And are they related to prices?
They are. Yeah.
Is it the PPI or producer
Nope.
pricing?
Nope.
No.
I told you I had to make it hard because of last week.
No, I know.
You,
Yeah, that's
you
well,
guessed
last
food
week
prices.
was hard, but yeah. Last week was the food price index, I believe.
Yes.
Yeah, from the UN. Jonathan, Michael, any thoughts there? You're saying it's derived from the consumer price index,
Right.
CPI. And
Fuel related?
Both
No,
both
not
year
directly.
over year. Is it something we cover, regularly, or is this kind of more of an esoteric series? It's more of an esoteric series.
It's from
Is
the
it
Atlanta
is it-
Fed.
It's
from the
released by
Atlanta
the Fed.
Atlanta Fed.
Is it the wage tracker?
Nope. That's a
The
cool one.
Atlanta
This
Fed
is another
releases
cool
a
one they
wage
have.
tracker. Yeah, tracks wages. Geez, Louise.
Done?
Can you give us another hint
up.
without giving it away? Atlanta
Think
Fed.
of the magnitudes, right?
Yeah. Can you give us one and not the other?
Well, if I give you one, you'll guess the
We'll
other.
get the other. Okay.
Okay.
All right.
Yeah.
I give.
You ready?
You guys give? You guys
Yes.
give?
Uncle?
You give.
All right.
We all give.
So 20% is the flexible price CPI, and 4.7% is the sticky price CPI calculated by the
Oh,
Atlanta Fed.
right. You know what? I never
Right.
look at that. I look at all the Cleveland Fed median and trimmed mean, but I don't look at the Atlanta Fed. It sounds like I should. So explain
It's pretty cool.
Explain this to people and what it's saying.
Yeah, so the idea here, kind of like the difference between the headline and the core, you're trying to abstract some type of volatility, if you will. The idea here is to look at each of the 300, 400 individual price components and identify those prices that tend to move very rapidly, right? So gas prices are a good example. They move very rapidly within say a 3-month period. And there are other prices that tend to be sticky. They don't move around all that much. They're more gradual. So the idea is to separate out all the different prices in the CPI report into these two categories and track those measures over time. The reason why you probably don't look at it most of the time is because they tend to be pretty stable, right? Doesn't really give you much more information, but at a time like this, it does give you some sense of what's going on. And in particular, the theory behind the sticky price index is that actually should incorporate more of an inflation expectations, right? If there are prices that you can't really change all that frequently, that tend to get stuck, then the price setter is going to incorporate more of the inflation expectations.
Oh, that's an interesting point.
Yeah.
A very interesting point. Yeah.
Yeah. So
sticky prices are more influenced by people's businesses' inflation expectations. Yeah.
That's right. Because the flexible, you have, if I get it wrong
sure.
this month, the market will adjust relatively quickly. But these other ones maybe more.
And what did you say sticky was?
4.7%.
Okay. Because house prices are key. I mean, the housing, not house prices, but the housing costs, consumer price index is a big part of that, I would assume.
Yeah, that's right.
Did you say that already? Okay. I missed
yeah.
that. Okay.
And so the sticky price index was 4.5% last month. So it isn't, it is indicating that consumers certainly are still worried about inflation, and that's feeding into the expectations and prices as well. So.
Interesting. That was a good one. We have to start following. Jonathan, did you know that? That's the rest of your Fed, the Atlanta Fed. Did you know that?
It's not something I follow. No.
You're not as data geek as I thought you were. I thought you were really one of those really.
Yeah.
Mike's really a huge data geek. I think Mike processes. I think he's. I think Jonathan, you told me before we started that you were the biggest user of our data buffet
At
data
one point.
service
Yeah, at one point.
at
Yeah.
one point. I think Mike is now. Mike turns.
Karl's gonna start charging me.
Yeah, Karl's going to. Yes,
There
exactly.
you go.
Karl's gonna, he's definitely making your life more difficult. I know that. Talk about budget cutting. So anyway, okay. Well, I wanted to talk about the other big economic release of the week, and that was retail sales. That came out, and
Yep.
Cris, you want to give us a rundown there? What happened with retail sales for the month of March?
Yeah, so I'd say on the surface, retail sales look healthy. They grew 0.5% in March, right? So that's good, right? In the sense, consumers are still spending. They're not cutting back dramatically. However, if you dig into the data a little bit, what you find is that much of that increase is due to rising prices, right? So gas station spending, for example, was up 8.9%, right? That's a big contributor to that measure. What else can I tell you? There was a revision to the retail sales for February. They increased from 0.3% to 0.8% growth. That actually is important, or is relevant as we think about GDP in the first quarter, right? So these retail sales numbers do feed into the GDP calculation. I think Ryan's gotten into this in the past about the control retail sales and whatnot. So from that standpoint, our GDP estimate has actually gone up a bit for the first quarter. So that's the positive. But again, there's some cross currents here. People are increasing their spending, but not organically. It's because they're facing these higher prices. And
yeah. Well, Scott Hoyt, who's another one of our good economists who is all things retail. I think he was formerly chief economist J.C. Penney. He sent data yesterday showing retail sales, nominal retail sales. That's what you're talking about. The 0.5, and then so-called, well, not so-called, but real retail sales after inflation. And this is deflated with retail prices. So corresponding prices to what's being measured here, retail goods. And this I didn't know this, but the real retail sales has not increased at all in about a year. It increased about a year ago when the economy reopened, when vaccines became available, and then we had the American Rescue Plan that helped support demand. But since about March, April last year, they're flat. There's no increase in real retail sales, which is part of that may also be shifting now because people are out and about, they're traveling again, so spending on services is improving.
Right.
So overall consumer spending continues to move forward, but so part of this is just a shift in preferences back because the pandemic is fading. But nonetheless, I found that pretty fascinating. Very interesting.
Yeah, I guess related to that, non-store, I don't know if you caught this, but non-store retail sales actually fell.
Yeah, I saw that.
6.4%. So
big decline.
Yeah, that does suggest people are
Yeah.
changing behavior, right? Going to the supermarket.
They're going back to stores again.
Yeah.
Yeah. Interesting.
So yeah.
Well, the other part of the story here is vehicle sales.
Right.
And they remain weak, right? So in the month of March, new vehicle sales were 13.3 million annualized. And as I said earlier, pre-pandemic, we were rock solid 17 million at least units per annum. So I guess I throw it back to the two vehicle mavens. When are we going to get back? Well, I got a bunch of questions. I guess when are we going to get back to something we would consider more consistent with long-run trends, which I guess would still be 17 million units per annum. And in that vein or in that context, how much so-called pent-up demand is there out there, right? I mean, people putting off purchases because they couldn't get a vehicle because they weren't being produced, or some demand destruction like Mike was talking about because prices are too high. How much is that pent up and going to come back in sales in the future? And Mike, I should preface this by saying Mike and I have been having a long running debate, although I think I'm like now in his camp or something. I think.
Oh,
Well,
you've
I
been
think I
captured.
moved in his
So,
direction. I'm not sure. But anyway, but let me throw that to Jonathan first and see what Jonathan has to say.
Well, I think we've got years before we see the supply problems, which we were discussing earlier, are the dominating theme in the new vehicle market, because this is not a scenario where you just bounce back to what the production once was, because you've got multiple new kind of factors leading to the fact that production is actually likely to be less over the longer term, or at least severely constrained for a period of time. One, we're undergoing a shift to electrification, and that means retooling plants. The plants tend to be more expensive. As a result, there's more combinations, more partnerships, and in essence, I think you can argue lower long-term global capacity for production. And now, because of the pandemic and what we've seen with the dependencies on weak parts of the supply chain, plus issues with certain parts of the world, Russia, China, becoming less reliable in the future, there's more of a focus on resiliency than absolute lowest costs. And I believe that's reducing overall capacity, reducing overall efficiency, and the net is global production probably peaked in 2019, and we're probably not going back to that number anytime soon. So the way that we look at it from new vehicle sales is that we had the potential in the short term to be selling 18 plus. We have built up pent up demand. We think it's in the neighborhood of 3 to 4 million units combined across retail and fleet, which further adds to the assumption of supply sitting on dealers' lots, or traditional measures of supply in total units or days supply, is likely to be well below normal for years as you slowly get that production back up to capacity. But the reality is that the challenges in 2022 will likely persist through the end of the year. And this is more of, you start to improve in 23 and into 24. That's not what we thought coming into the year. Coming into the year, we thought this was the year you start to see gradual improvement. And then by 23, you're getting to some new pace of activity that's likely 16 to 17 million. But we think that's been pushed out roughly a year.
Wow, interesting. So, as I mentioned earlier, the average sales is, since the pandemic hit, is 14.65 million. That's annualized. We were 13.3 in March. So where do you think we'll be at the end of the year, Jonathan, roughly speaking? Are we going to be at 14.65, or are we going to be still?
We're calling for 15.3
for the year.
And I think the range is likely 14.9 to 15.3. So in other words, I think there's risk to the downside to the 15.3 that we currently forecast.
Okay. And you said 3.5 to 4 million in pent up demand. That's the demand that was put off during the pandemic that will come back at some point here when there's enough supply.
Yeah, there's a solid 2 million at least in fleet that would be buying. And it's not just an issue of prioritization and making those vehicles available. It's literally production. The manufacturers have prioritized where the chips go and where their staffing issues are preventing them from being at 100% in a factory. They're only producing certain vehicles, the most profitable vehicles, the most profitable configurations. So we've got strange shortages, even in things that you would think would be more expensive, like vans and things that are important for delivery. That there's a substantial amount of pent-up demand that's going to take quite a while to get to a level we can produce.
Interesting. Hey, Mike, you heard that. I think my guesstimate for pent-up, and to be humble here, estimating pent-up demand is not easy, because estimating trend demand for the vehicle, I've tried this over a 30-year period, and it's really tough to do, particularly given the pandemic and the effects that has on preferences and driving and depreciation rates and so forth and so on. But I'm coming up with like 2.5 million units in pent-up demand. What do you have a sense of do you have a view, Mike? I think you do. I know
it's
you
closer
do,
to two. Closer to two.
Closer to two. Okay.
Because I keep a close eye on those miles traveled, as
Yeah.
well as the employment at vehicle maintenance facilities to be able to try and keep track of who's bringing the cars in for longer, who's basically driving through the demand that they have, and who's not driving as much. So you have two different ways that you can decrease the amount of demand that's not being fulfilled. I don't keep as close an eye on the fleet side as Jonathan, but we do have those total numbers, which do include fleet from the BEA.
Yeah.
But I'm just more concerned in the short term with the neon issue. I know we beat that drum before,
The
but
what issue? The
the
what issue?
neon issue for the
Oh, yeah.
semiconductors, the
Right.
50% has been taken offline. Neon prices are up. The semiconductors
That's Russia
producers,
invading Ukraine, by the way,
yes,
right?
yep,
Is
Russia
it?
invading Ukraine. So InGas, I believe, is it's located in Mariupol. So they've been
that
shut
right?
down. Yes, that's where they're located. So they're not producing. They were shut down immediately. And Cryoin, they're in Odessa, and they shut down. And they said they don't think they're ever going to be able to open back up. So because they don't have supply of the raw material to make the pure neon for these lasers. I'm concerned that these large producers, so Intel, TSMC, they have a 6 month supply and backlog, and then this is going to be burned through faster than they can find new sources of supply. So I think there's a real risk to how new semiconductors are going to be produced in the second half of this year.
Yeah, just to connect the dots for everybody. So Russia
Yep.
invaded Ukraine. Russia, Ukraine produce a bulk of the neon for global export markets. That neon is used for lasers that etch chips. The chips are obviously used in vehicles. So if I don't have neon, can't produce chips, I can't produce cars, and that's what you're saying. It hasn't had an impact yet because there's a backlog that their producers are blowing through, but it feels like this is going to be an issue in the second half of the year going into 23.
Definitely.
I got that right. Okay.
Yep.
Jonathan, is that right? Is that right? Is
Yes.
there any new? That's right. Okay.
And I don't know if most of the production forecasts have baked in those challenges, because if you look at the production forecasts, they start to improve
Yeah.
at the end of this year, and that injects risk.
Okay. All right. That's a little depressing. Hey, we've been chatting here for I think a little over an hour, so I don't want to keep. I want to respect your time. So we've got probably another 5-10 minutes to go. So the question to the group is, do we want to talk about? I'll give you three choices. One, electric vehicles. Two, kind of new innovations in the vehicle industry around the way we sell cars and the way we buy cars and what are in cars. What is a car? Or three, the stagflation. Stagflation because that's kind of people's top of mind, and we kind of been dancing around that this whole podcast. We began with high inflation. We talked about weak retail sales. That's kind of in the spirit of stagflation. Okay, so what do you guys want to do? Which one of those do you want to talk about? Mike wants to talk about the Phillies, I know, but we'll have to table that. Jonathan, you're our guest. I'm going to let you choose. You pick which one you want to choose.
I choose stagflation because
interesting.
That's not. I think it's super relevant to be talking about, and we can have another session to talk about electric vehicles and new innovations and mobility.
Absolutely, well, definitely. And then by then, my brother Karl will have approved the budget for the cowbell, and I can give you a cowbell. But anyway,
that could be a while. That could be a while.
That could be a while. Jeez.
We'll have autonomous vehicles by then.
Yes, exactly.
Flying autonomous.
A flying autonomous vehicle. Yeah. Oh, okay. So, all right, Cris, you level set. Define stagflation for the folks out there. What is? Because I think people they've heard stagflation. They know they don't like it. They don't want it. But what is it exactly?
Well, there's some differences in the definition. I would say it's a combination of high inflation and low growth. So higher unemployment combined with high inflation.
So would you say if inflation stays, you go back to your sticky price, say around 5%, 4 or 5%, and unemployment is, let's say 4 or 5%. Right now we're at 3.6. So let's say it's closer to 5. So 5 and 5. If we had 5 and 5, a period of 5% unemployment, a period of 5% inflation, would you consider that stagflation?
Well, that's a good question. I probably wouldn't,
You
because
wouldn't.
I think
Oh,
of, well, it really depends on the trend, right?
yeah,
If you're saying inflation is high but trending downward, and
yeah,
unemployment maybe is up but stable or actually trending down, then yeah, maybe it's stagflation for that short period. But
yeah.
in the sense of it being a problem that I have to
Yeah,
worry about, it's
let's
really
say
about
that
that.
that's the world we live in for, at least a couple of years. Would you consider that stagflation? Jonathan, would you consider that stagflation, or how would you define it, or would you define it differently?
Well, I think of stagflation as the late 70s, and that seemed to be
Okay.
more extreme and a longer period and
Okay.
relatively unique. But I I really wanted to hear what your opinion was on that.
Well, I
'Cause it
don't think
seems
there's
like
I think there's very little likelihood we get to, well, the 70s and 80s, that was a period of, I don't s- a period double digit, consistent double digit
Right.
inflation, and a period of not double digit unemployment, but very high unemployment, 5 to 10% unemployment. So we went back. Mike, did you look up what was June unemployment in June of 1981? I said 7.3. I made that up, but that gives
Seven
you
four,
are you kidding me? It's seven.
second quarter. Yeah.
Okay, wait a second. We're going to stop for a second. I want everyone to
Well,
recognize. What do you think?
All right, Ben, our
All
you have to
right,
splice in the
okay.
cowbell at
7.4.
this point.
And I'm sure the seasonal adjustment factor was off and it was actually 7.3. I'm just saying. I'm just saying. But anyway, that I don't think there's any I don't think we're going back. That's pretty hard to get to that kind of scenario. So in my view, if you get 5 and 5, 5% inflation, 5% unemployment, that's going to feel really ugly, bad. I mean, it already feels bad, but that's going to feel really bad, and I consider that to be stagflation. Let me ask you this question. And maybe I should say also the reason I don't. There's a lot of reasons why I don't think we go back to the 70s and 80s. I mean, people don't recall, but the 70s and 80s took almost a decade and a half to get to the 70s and 80s. With regard to inflation, that became a problem beginning in the 60s. The very expansive fiscal policy, Vietnam War, the Great Society. It was also related to labor market dynamics, where we had a lot of cost of living adjustments built in. So if wages rose, that got into prices. If prices rose, that got into wages, which got into prices, and you got into this wage price kind of spiral. The Federal Reserve didn't really understand the role of inflation expectations. That wasn't even a thought back in that period. That was something that we learned how important that was coming out of that period. So I think there's a lot more differences between now and the 70s and 80s than there are similarities. But that doesn't mean we can't go into something that is stagflation-esque, like a 5 and a 5. But I would say, and I'll give you my view on the likelihood of that, and then I'd be curious, your views and whether you'd push back, is that the probability of that happening, of us going into any kind of stagflation environment, is pretty low. And the fundamental reason is, it's a policy choice. It's a choice. It's the Federal Reserve has to allow that to happen. And based on the very painful experience of the 70s and 80s, when they learned that the only way out of stagflation was a very, very prolonged and severe recession, in fact, 2 recessions back to back with double-digit unemployment to get us out of that mess, they would err on the side of pushing us. They would push us into recession earlier to ensure that we didn't get into that stagflation environment. So, if it felt like we're going down that dark path, they'd say, okay, I'm going to raise rates now, and we're going in, and we're going to wring out these inflationary pressures and get inflation expectations back down to something more consistent. That it's a choice, and they're not going to make that mistake and make that choice. You can always make a misstep, and you could misread, and you could end there. But I'd say the probabilities of that are pretty low. I'd say put them at 1 in 10, something like that. What do you think, Cris? Do you have a different perspective, a different view?
I actually think it's even lower than that.
Even lower than that.
The Fed is, well, the wild card here is some politicization of the Fed, right? If we if
That's a point.
the next president were
Yeah.
to appoint someone
That's a point. That's a good point.
to, favor certain policies, that could backfire. But I think fundamentally it's kind of ingrained in the Fed at this point, given the 70s and 80s experience, that inflation has to take priority, right, of the dual mandate at the end of the day. And so I do think they will slam on the brakes hard as necessary to get inflation under control at the cost of a recession.
Yeah, good point. Hey, Jonathan, Mike, anything you want to add to that conversation around stagflation?
The oil independence of the United States means that we're not going to have an aggregate supply shock the way that we did in the late 70s.
Great point.
We're less dependent on oil and gas than we were at that time as an economy. So those things I think also help with the case that it's not very likely to happen without I didn't even think of Chris's point about politicizing the Fed. That didn't even cross my mind. Now I'm scared of that.
Yeah.
But yeah, so I don't think it's very likely to happen.
Yeah. Jonathan, any perspectives, any views?
Yeah, I think I agree with all of the arguments that you guys are making that make it a less likely outcome. What I'm observing, though, is this interesting thing that Wall Street seems to be presenting as we have two likely binary choices ahead of us: stagflation or recession. And actually, even your podcast last week, I think
that was pretty depressing, wasn't it? Yeah.
Was it
Mr.
75?
Dorides, he went to the dark side on us. Yeah.
Not the very dark side.
It's pretty dark. I thought you said.
But it sounds like making the choice and looking historically. I was looking back at what vehicle sales were in the late 70s, and definitely that environment of high interest rates and stagflation scenario was not super supportive of strong vehicle demand. But yet, if we had a recession that broke that, and that recession played out more like the 2001 recession, which is sort of where my head went in the discussion from you guys last week, that sounded like a much better environment for the vehicle market. So I guess I would root for the recession over stagflation.
Yeah, I'm with you on that one. Okay, very good. Hey, Jonathan, do you have a Twitter handle?
Yes, at
what
Smoke on Cars.
Oh, that's a great one. That is a great one. And Mike, do you have a Twitter handle?
No, I don't.
Okay, smart move, by the way. And I know Cris does. What's your Twitter handle? But you're a LinkedIn guy.
I never
you're a LinkedIn
check
kind
it,
of guy.
So, yeah.
And I'm at Mark Zandy. Just saying, or at. You know how to spell Mark Zandy, right? Mark Zandy at Mark Zandy. Okay.
And you're not a LinkedIn guy. Yeah.
And I am not a LinkedIn guy.
Right,
I've not evolved into. That's a higher level of being. I've not gotten there yet. Yeah. Anyway, Jonathan, it was fantastic having you on. I appreciate it. And we're definitely having you back because we have to talk about EVs and all these cool things going on in the auto sales market.
Mike and I are working on EV affordability analysis. So maybe that'll be use.
Perfect.
Okay, very good. Very, very good. And Mike, good to have you.
As always.
You weren't as combative this time. I don't know. Well, maybe because I agreed with you.
You agreed to my forecast this month.
That's how it works. Okay. Fair enough. Very good. And with that, we're going to call it a podcast. Take care, everyone.